A lot of times when we see people that have made bad financial decisions, it was made out of fear. So they're fearful that they're going to lose money most of the time, and so but the best way to guard against tax increases, inflation, markets dropping, all that stuff is to diversify. And I know people like it's a very simple term, it's probably cliche and overused, but honestly, diversifying, holding different asset classes is the best way to guard against all those things. But what people do is they get so fearful of one particular thing, in this case, losing money, that people prey on that fear, other salesmen, they end up buying products. And it could be anything from locking up a long-term CD with the low rate. It could be buying a treasury with a low rate. It could be buying, the new thing is indexed universal life insurance policies. They never lose money. They always go up. Or, annuities. Like people make those decisions out of fear. And for whatever reason, they all of a sudden just say, yep, I don't want to diversify. I'm going to put it all in this because it's going to take care of my one fear. And then they get into it a couple of years and they realize that probably wasn't a very good idea. Yeah. And so I think the fear, the one fear of losing money is honestly what we see as the culprit for people making some bad decisions.
When we start talking about fear and market changes and historical things, there's one thing that's happening in the state of Nebraska right now that's pretty interesting. I don't know how much of an impact it's really going to have on the market. And I kind of want to get your guys' opinion on it. The Oracle of Omaha. What are your guys' thoughts? And is there going to be an impact because of what's happening over there?
Well, let's be it. So yes, there's going to be an impact. But I don't know that the impact is going to be sudden, and I don't know that it's necessarily going to be negative either. Just because you think about it, Warren Buffett is the one that made so many of these decisions. He's the one that did a lot of research. I mean, he's the Nick Saban, right, of Berkshire. He's the one that drove that thing up. And so when Nick Saban retires, of course, Alabama's going to take a step back. So it's the same type of thing. Like Warren Buffett retires, like you don't just replace Warren Buffett. I mean, you don't replace one of the best ever with another best ever like that. No company historically does that. So yes, there's going to be changes. But we just like Berkshire is such a huge company and they own so many other companies. Like if you look at the list of the companies they own, it's like a mutual fund. Yeah, it's like a diversified fund at this point. So all those companies would have to have bad things happen to suddenly go haywire, right? And so it's more about going forward, are they going to have the leadership that continues to make investments in the right companies? So this isn't a big sudden thing where I think people need to go start selling Berkshire. I think this is more of a wait and see and give the new leadership a chance and see what they do and just kind of see where it goes. Because, this when Warren retired, what you own didn't change. He suddenly did just sell everything and give the new leadership a chance to go start from scratch. Like they still own most of the same stuff. So over time, I would expect that Berkshire is probably not going to have the same returns they had the last 50 years. But to that point, Berkshire hasn't had the same returns the last 20 years that they did the last 50. Like a lot of Warren's really good investments were made early on. And he's, like I said, he's one of, if not the best ever. And you don't just replace him, but I think it's going to be a wait and see approach.